Opendoor Technologies serves as a digital real estate platform disrupting traditional home sales via its iBuyer model. Its stock price has surged sharply due to a combination of retail speculation, activist investor signals, and operational progress toward profitability. Shares increased over 500% in just 1 month, topping out near $3.60 before pulling back slightly. This rally followed a predictive post by a prominent investor suggesting Opendoor could become a 100-bagger, triggering widespread attention on platforms like Reddit's Wall Street Bets and StockTwits. Technically, the price action resembled prior meme stock episodes, characterized by extremely high trading volumes, well over 1 billion shares daily, and high short interest estimated above 20%. These conditions fueled speculative momentum, gamma squeezes, and amplified volatility. Chart resistance stands near the 200-week moving average around 5. A break above could prompt further advances toward 11. However, indicators suggest overbought territory and risk of short-term pullbacks to support levels around $1.80 and even $0.90. Opendoor's business fundamentals have shown sequential improvement. In its first quarter of 2025, revenue reached approximately $1.2 billion. A slight year-over-year decline, but up 6% from the prior quarter. More importantly, net loss narrowed to approximately $85 million, significantly better than prior quarters. Contribution margin improved to close to 8.6%, and the adjusted EBITDA loss shrank from approximately $50 million to around $30 million. The company projects positive adjusted EBITDA of $10 to $20 million for the second quarter, which if realized would mark a key inflection point toward profitability. Operationally, Opendoor has refined its cost structure, targeting annualized savings of around $85 million entering 2025. Inventory levels have increased to roughly $2.4 billion across over 7,000 homes, positioning the company for future sales as market conditions improve. At the same time, homes under contract declined sharply, suggesting bottlenecked market demand or tightened acquisition discipline. Management signaled a strategic pivot toward a hybrid business model that includes agent partnerships and listing services, alongside its traditional instant buy offers to reduce capital intensity. Financially, while Opendoor has yet to turn profitable, its progress toward margin improvement and positive EBITDA, if sustained, offers scope for renewed investor confidence. The company maintains approximately $559 million in reported cash reserves, giving it liquidity to fund operations while pivoting the business model. Despite these operational strides, the housing market remains under pressure due to persistent high mortgage rates, low housing turnover, and macroeconomic headwinds affecting affordability and buyer demand. Analysts remain split. Some see the value in Opendoor's cost base and potential recovery in home sales, while others emphasize the speculative nature of the rally and the fragility of fundamentals absent a broader housing market rebound. A key driver of the rally has been investor excitement around emerging proprietary tools like Opendoor's Key Agent app, which streamlines home assessments and reinforces data quality to improve house valuation models and pricing algorithms. Investors anticipate this capability will improve offer precision, reduce holding costs, and ultimately boost margins. From a valuation standpoint, the current stock price reflects elevated expectations. Many models expect intrinsic value well below current levels if the company fails to sustain positive earnings, or if housing momentum weakens. That said, bullish investors argue that if margins improve, inventory turns accelerate, and real estate activity normalizes as interest rates decline. Opendoor could materially outperform. Predictions even stretch to $80 per share or higher, though such targets assume a full recovery in US home sales and operational scale-up. For momentum or speculative investors, riding the current wave may make sense, especially with the retail enthusiasm backdrop and short squeeze dynamics. For risk-averse or value-oriented investors, the stock may appear overextended, waiting for indicators like sustained positive EBITDA, continuous margin improvement, or a retest of key technical support in the $1.80 to $2.50 range could offer a more prudent entry. Risk factors remain substantial. Dependence on interest rate trends, macro housing affordability, ability to sell inventory without steep markdowns, execution of the hybrid business model, and the sustainability of buzz-driven momentum. If sentiment shifts or fundamental progress stalls, volatility is likely to increase and downside risk remains high. In summary, Opendoor's recent stock surge is driven primarily by speculative retail activity, activist signals, high short interest, and social media momentum, supported by sequential improvements in financial performance and growing optimism around a return to profitability. It is a high volatility, high risk name that has drawn attention for its potential turnaround and disruption in residential real estate. For long-term investors, success will depend on Opendoor's ability to execute on its evolving model, deliver sustainable profitability, and capitalize on improving housing market conditions.